Are you seeing right now, and this is on a personal note, of course, with any of the refinances that you've currently been working on, are you seeing that people have a lot of equity on their home?
Unfortunately, no. Yeah, that's
I didn't think so. That's why I'm asking the question.
yeah, the biggest problem we've certainly encountered in this particular refinance market is a lack of equity in many people's situations. So I think it's common to understand that your home probably is worth at least 10% less than you think it is, or than it was worth at the peak of the market. Um, some people can't refinance because they're completely what we say upside down, means they literally owe more than the home is worth.
Mhm.
Some people can't refinance because financially it doesn't make sense if they purchase the home and put 20% down and do not have private mortgage insurance. But at this point, if they refinanced and they've lost value, now they could be refinancing into a category where they now have less than 20% open equity,
Mhm.
and now they have private mortgage insurance. So even with a great rate reduction, the added private mortgage insurance expense kind of makes it financially not really beneficial.
I had a customer of mine who called me the other day who was in the process of refinancing her home. And she actually said to me that the mortgage rep told her that they were only going to refinance up to 80%. They were not going to do the full value, even though it may have a, let's say her house was for 200, it would have priced for 200,000. They were only going to give her 80% of that. Now, is it because banks are doing that to be a little precautious, not because we don't know where the market's going to continue to take us, and the house values just keep dropping and dropping. So are the banks doing that just to kind of have a cushion in the event that home was to now go less than 200,000, and they don't want to find themselves having now this loan, where the value is no longer there? Is that a precautionary measure that the banks are taking?
Yeah, absolutely. Certainly, the amount that banks are willing to lend now is a lot less than it used to be in relation to the home's value. In the scenario you mentioned, it sounds like they were possibly trying to take some cash out. If it were a single family home, their primary
Yeah.
residence, then the most we can do is up to 80% of the home's value. If you were refinancing simply to reduce your rate or your term of your mortgage without taking any additional equity out, then you can go a little bit higher than that with a couple different types of loans. But again, right in that instance, as soon as you go over the 80% loan to
Mm.
value mark, you're going to find yourself with private mortgage insurance.
Okay, excellent. Well, when we come back from this commercial, Mike's going to continue to fill us in exactly on what it is that we need to do to refinance our home loans. And we'll be right back after this commercial. Hi, and welcome back with the NJ Real Estate Show. We are here speaking today with our guest speaker, Mike von Hohonstein, who is from Oak Mortgage Company, and he is the senior loan officer. He's telling us and informing us exactly what it is that we need to do to be able to refinance our home loans. And we're finding that in this market, we're a little tight when it comes to refinancing. It's not like it used to be. I have friends who years ago they used to refinance their homes, because they wanted to buy two or three cars. They wanted to cash out money, take out, buy cars, buy a whole bunch of Nike sneakers. Well, that's not the case these days. The banks are a little bit tougher, when it comes to refinancing. We're in an economy right now that we're a little bit over the edge, and a lot of people are being very precautious of how they're handling now. The banks are being very precautious of how they're handling loans, any type of loan, whether you're purchasing or refinancing, especially with a refinance loan, because they want to make sure that the value of the home is there. And Mike, you were telling us, in reference to the refinance, with all the steps that someone has to actually take, what do you see yourself? I mean, what do you see when you're doing your loans? What is the only thing right now that a bank will allow for a refinance? Because, like I said before, I have friends, they used to just refinance and they bought a whole bunch of stuff. They went on trips, Hawaii this, Hawaii that. Well, now the banks are like, are they really cutting down and say, okay, what do you want to refinance for? What is the true purpose of why you're refinancing? Because in the past, too, some people used to refinance their homes because they were also going to buy another home.
Right.
So I know a lot of things have changed now. Tell us a little bit more about that.
Yeah, definitely tighter lending standards and more a tight eye on documentation as far as what cash out would be for. So if it's anything for other than the obvious, well, I'm changing my rate and term. If I'm taking any type of cash out, then we're going to want to know where it's being applied, whether you're paying off a second mortgage, maybe paying off some other debts, credit card debts, car loans, and a lot of those will require to be paid off on the settlement sheet at closing, so we know that that's where the money went, and you didn't just go out and take on another new large expense. So I think you mentioned a second ago some people would take cash out of their home to go buy another home. We've got to know where that money is going.
Sure.
We ask the borrowers to write something called a cash out letter that explains in detail where this money is going. And if it is to take on another large expense like the purchase of a home, then we're going to need to know what that is going to entail, make sure they qualify carrying that debt as well.
Sure. Now, when the person refinances and they do a cash out, they get a check. Do they get a check?
Yes.
They get a check that's made out directly to their name, correct? Okay. Do you ever foresee us in the future, instead of giving that that check directly to that homeowner, in a situation where they're going to pay off a second loan or they're going to pay off a specific debt, do you ever foresee the banks in the future saying, that's perfect, we're going to give you the refinance loan, however, we're going to write out those checks to make sure it goes to those places where you're saying that's what's going to be utilized? Do you ever see us in the future going into that system?
In a way, yeah. Actually, we're sort of there in one respect. Matter of fact, I had a client who closed earlier this week, and to qualify, we had to pay off certain debts, or that was her goal anyway. But in order to make her debt to income ratio work, had to pay off X, Y, and Z credit cards. And when the disbursement check was cut, one was sent to her current mortgage company to pay it off. And then separate checks are made to, Discover, Capital One, and whomever else we were paying off, literally to those entities. She just has to mail them in. The difference is a cashier's check to her, because she needed those debts to be paid in order to qualify. So we had to know that's where the money was going. But I guess to answer your original question, I can definitely see that being something we'll do. So they can't just say, I'm going to pay off this and then don't, and then take that money and then go do something else with it.
Correct. Because one of the things that I have to mention is that I'm a true believer that when someone refinances their home, they're really doing it because, first of all, they either want to bring down their rate, because the rate is going to tremendously reduce their monthly mortgage payment, which is a plus, and so they're saving money there. Or because, like you said, they're going to pay off a debt, because some people have credit cards up to the gazoo, and the credit cards have a 22% interest rate, 29, 39. It's just crazy. So why pay all that? Why pay those interest rates on those credit cards when you could just pay it off in one lump sum and not have them? But what has happened is I think that some people, they take advantage of the situation. Like you said, they say they're going to pay it for one. They're going to use this refinance to pay something. And then, I have clients and customers from the past that I saw when they were going to refinance. I saw when they went through the process. And next thing you know, they're back to square one now, because they went out and bought the lavish cars. They went out and bought lavish clothing and shoes and stuff. Well, those things are not things of value for the future. So, the reason I'm so glad that you're here with us, Mike, today, telling us about the refinances, because a lot of people just think, hey, I could refinance my home and I can get this and I can. No, when you really refinance your home, you want to do it because there's a real true purpose behind it. You're either, reducing your mortgage payment on a monthly basis, or you're paying off a debt that you yourself know you just can't pay off until like 10 or 15 years from now, additional to your mortgage payment, and that's just drowning you, and you just want to get rid of that debt. What else could you fill us in as far as refinance? What are the new trenches? What's in the trenches now with refinancing?
You know what? Curiously, one of the bigger hurdles we're facing these days is documentation requirements. So I know in the past, especially over the last several years, particularly self-employed clients could do something called a stated income loan, where they said, this is how much I make, if it was within a realm of realism for what they did. So in other words, if you worked at McDonald's, which is a respectable job, but you said you made $90,000 a year flipping burgers, then that's something a little bit curious. So, but from a documentation standpoint, with self-employed clients, with other type of clients, we need to see everything these days. Tax returns, bank statements, W-2s, all that sometimes wasn't necessary in the past. So definitely a bit more stringent as far as that goes. And along the same lines, oddly, there's a form that we have to execute called a 4506, and we send it to the IRS, and they send us back a highlighter, a version of what the client filed for their tax returns. And often now I'm finding that the clients have not filed their tax returns for whatever reason, extensions or whatever, or just haven't filed at all. I had one particular client who said, they owe me money, so I haven't bothered to file. So we can't do a loan if you haven't filed your tax returns. So for whatever reason, some people just haven't. But if you haven't, you're stuck.
And actually, that's good information, Mike, because a lot of people, they don't file the income tax. I mean, I'm dealing with a customer right now that they haven't filed in 3 years. And now they had to acquire a company. Oh, it was a mess. That'll be another story for a later date. But yeah, you have to do your taxes in order to be able to refinance. Not only that, they're gonna verify, because now my understanding is that when the lenders are looking whether it's to refinance or do a purchase, they just no longer look at the bottom number. They look at the whole hardcore of that income tax return to make sure that there aren't things there that are misconstrued, or somebody didn't deduct a certain amount and you say, wait a second, so your income really wasn't this, it's really this. It's I'm assuming just getting a little tighter and tighter.
Exactly.
With refinancing. Okay, when we come back from this commercial, Mike's going to give us some quick tips on things that you should do and not do, and we'll be right back. Hi, we're back with Mike von Hohonstein from Oak Mortgage Company. He's a senior loan officer, and he's going to now, in closing with him on the show, he's going to give us some tips of what we should do and what we should not do when we're trying to refinance. Give us some pointers. Give us some tips.
The first thing I would say for many people is, if you're preparing to refinance, start gathering your documents right away, because you're going to need them. You're going to need 2 recent pay stubs. You're going to need your last 2 years federal tax returns. You're going to need your last 2 years W-2s or 1099s. You're going to need your last 2 months worth of bank statements, driver's licenses, your current mortgage statement, and usually the first page of your homeowner's insurance policy. If you own other real estate, you'll need information on those properties as well. A big thing is, don't do anything new with your credits. Once your lender has looked at your credit scores, don't go out and apply for new credit. Don't pay off any old derogatory items unless you've been instructed to do so. And especially, do not go out and run up new credit. So thinking that, I just have my credit pulled, he's not going to look at it again. We're actually required, this is something very new this year, just before closing, we're required to do something called a soft pull credit report. So we're not going to hurt your scores, but the underwriter will look at the credit, make sure you haven't taken on any new substantial debt, because if you have, we have to qualify you with that debt. And a couple of times it's happened lately where someone's going out and bought a car, and all of a sudden with that extra $300 or $400 mortgage pay or monthly payment, they don't qualify for the mortgage anymore.
Well, that's good insight. Thank you, Mike, because let me tell you, sometimes people, they get so excited that they're refinancing. Whoa, it's gonna fall through, and they start doing things they shouldn't during the process.
Absolutely.
How many times should someone actually refinance? Can I refinance? I'm gonna give you a perfect example. I know people who refinance every year.
It really depends on your end goal. The unfortunate thing about refinancing is you typically are adding money back to your loan. You're adding principal back to the loan, unless you're paying all your closing costs and escrows out of pocket all the time, which very few people do, because it is costly. It's very similar to a purchase transaction in terms of overall costs. A little bit cheaper, but still expensive. So unless you're really refinancing for a solid, tangible goal, and actually we're required as loan officers to make sure there's some tangible net benefit to the borrower. We just can't refinance you for the heck of it, where it used to be, unfortunately, a common practice. So there's got to be some financial benefit to you, whether you're reducing your rate, reducing your term and shaving years off your mortgage, taking equity out of the property to do something else of a financial benefit, whether it be paying off a second mortgage, taking out a loan to help kids pay for college, pay for a wedding, something that really makes sense, and ideally, hopefully, not putting the borrower in a worse off financial position than they were in to start with.
Well, Mike, I really appreciate that you were able to join us on the show
Thank
today
you.
to give us some wonderful tips and information that has to do with refinancing your home loan. And I want you to know that Mike's information will be on all my blogs. They'll be on all my websites. So if you want to contact Mike directly and ask him questions, you have further questions that you may have not heard here today in the show, please feel free to call him. His numbers and his emails will be there for your use. And Mike, I just want to thank you. I hope that you enjoyed the holidays, And we'll be right back after this commercial.